Hello and welcome back to this theoretical course on commodity spread trading, looking at how we can use them to trade for profit and diversify our investments within our portfolio. This is the second video in this section where we're looking at the technical analysis that should always be undertaken before placing trades. In this video, we'll look more at the tools and charts that are available to evaluate the opportunities identified in the fundamental analysis using the information that comes from the statistical databases. More specifically, we will cover off Bollinger Bands, what they are and how they can be used, the importance of historical correlations when comparing performance of past and present spreads, and the impact that large institutions have on spread trading. So, without further ado, let's crack on with Bollinger Bands. These are another means of technical analysis, a very useful tool to identify the phases of expansion and contraction of volatility on spread prices, and therefore important in helping to identify or anticipate future price and market movements. In the graph shown, the price is bracketed by an upper and lower band, identified by the purple and yellow lines. The blue line seen between these is a simple moving average of the price over the time period shown. The upper and lower bands plot two standard deviations away from the simple moving average. Because a standard deviation is a measure of volatility, when the markets become more volatile, the bands widen, and during less volatile periods, the bands contract. When the bands come close together, a period of low volatility is indicated. This can sometimes be referred to as a squeeze, and is considered by traders to be a potential sign of future increased volatility and possible trading opportunities. As mentioned, when the bands are wide apart, this indicates a period of high volatility in the price. However, these conditions are not trading signals. The bands give no indication when a change may take place or which direction the price could move. Therefore, they should never be used as a sole means to evaluate trades. Further analysis using tools is required to further refine the details of the opportunity identified. The majority of the price movement occurs between the two bands. When, however, the price does break out of either the upper or lower band, it's a major event, but it's not a trading signal. Many people make the mistake of believing that the breakout exceeding the limits of one of the bands is an indicator to buy or sell depending on the direction the price has been moving. This is not the case, as the breakout does not actually provide any indication on its own to the direction and extent of the price movement. For a further example, let's look at a chart of a spread on soybeans. Again, using Bollinger Bands, we can see periods of reduced volatility where the bands come together, and the periods shown by the widening of the bands where it is increased. This can help us identify what actions we want to take in opening or managing a position. For example, at times of high volatility, it would not make sense to put stops too close together. On the other hand, we could put the stops too far apart, increasing the risk associated with the trade. Or we might interpret the information as not being the right time to open a position, in which case we've saved not only money, as the trade would most likely fail, but time as well. Now, we'll cover how to use stops to protect ourselves in a future episode on money management. For now, let's move on to look at correlation. We've already looked at correlation in an earlier session when we first started talking about raw materials and spreads. We explained, and hopefully you remember, that in order to trade a spread, we need two related commodities. As we've said, we would never make a spread between oil and sugar, as they are very different materials, have very different performance, and above all are influenced by very different macroeconomic variables. But we could definitely trade a spread between oil and petroleum, given the obvious relationship between the two materials. Having discussed the possibility of trading a spread between related materials, we'll now look at how past performance could influence decisions we make in the present and explore the correlation of a current spread against the same spread from previous years. This graph is showing the correlation between the spread on cocoa that was current at the time the graph was produced, shown by the black line, against the same spread from 2002 data, which is indicated by the green line. During the life of the spread, there have been 205 days of correlation where the price movement matched across the two spreads. That's a correlation of 93%. Now, something to take note of. When looking at historical correlation, normally anything over 80% when you're comparing current against historical spreads should catch your eye. But what does this correlation show us? We have identified a possible entry point indicated by the light blue column where we could potentially go longer the spread given the upward movement shown in the historical data. As the current spread has tracked movements of the previous one, we can assume that it will continue to do so. Given the strong bullish trend, it appears to be a good opportunity to enter the market. But let's look at the other data available on the chart. At the very bottom, we can see the volume. As you would expect, this increases as the near future gets closer to expiry. This could be interpreted as another good sign. Now take a look at the two lines directly underneath the main chart. The dark blue one shows the 15-year average of the spread. The trend is somewhat similar to both the current spread and the one from 2002, so this still looks like a good opportunity. But what about the dark red line? This is the 5-year average price. Not quite such a good correlation, is there? As you can see, following a short upturn, the trend in the 5-year average turns somewhat bearish and falls below where the entry point was identified. Not exactly a good sign if you're looking to go long. So what can we do? We could check correlation of the proposed spread against those of other years, perhaps looking at the most recent ones to see if there was some anomaly that affected the 5-year average. If they correlate and have an average above 80%, it could still be a viable trade. If, however, they do not, it would perhaps be better to walk away from this one. So what can historical correlation tell us? Firstly, the possibility of a possible trade where there is a high correlation between the current and past spreads. Secondly, the potential of a reversal. As with all analysis, this on its own does not present a strong enough argument to trade. Further technical analysis will be required to confirm the proposed action. Okay, now to move on to a topic with a bit of bite. Your interest in commodity spread trading is an example of the increase in traders and investors that we have seen in recent years, with many having been attracted by the excellent results that have been achieved. Success breeds success, as they say, and I do hope your journey becomes a successful and profitable one. Unfortunately, it has not only been the small traders like you and I that have been attracted to commodity spreads. Institutions now operate in the market and have become the real leaders and market makers. Their actions can at times create real traps for us smaller investors, or cause the data we often rely on to put out false signals with regard to market movement and opportunities available. I'm not for an instant suggesting that they've entered the market in order to manipulate prices and take control of it. But like you and I, they have identified it as a market of great opportunity and potential and look to gain advantage from this unique type of trading. In the first video, we identified that one of the advantages of spread trading was that it provides better protection compared to other types of trades, due to the action of buying one future whilst selling another. That having been said, no one can be completely free of the risks created by the way the large institutions sometimes trade. Let's look at one of these risks now. As we have covered in earlier videos, one of the keys to successful trading is analysis, both fundamental to identify potential opportunities and technical to confirm them. The signals that we get from the markets are followed by many traders and are the basis for the majority of trades placed. In fact, as I've repeatedly said in these videos, having the information, understanding it and evaluating it correctly are some of the main factors in becoming a successful trader. Occasionally, due to the nature and the way the large institutions trade, the data and market information can become a little distorted, the result of which is that false signals can be given out. The analysis and evaluation completed using the information and signals provided may not lead to the results that were expected. Now don't let that scare you or put you off progressing on this journey. This is not unique to spread trading. It's something that is present in all markets. There will always be something that breaks away from the norm. The thing to know is that false signals exist. Learn how to identify them and then know how to turn them to our advantage. So let's look at how and also at what happens. Where particular areas of interest have been identified, there will obviously be an increase in trades, especially if the analysis backs up what's seen. As smaller investors and traders look to open their positions, and probably more importantly in this instance, place their stop-loss orders, a high volume of orders can accumulate quickly. And that's what we're showing in this chart. An entry point has been identified and the period of the trade is shown in the yellow column. The situation here is that institutional traders are extremely aware of the accumulation of these orders and, more importantly, the price levels where they are likely to have been placed. The information is available to all on the statistical databases. They would also have an idea where the majority of small traders' stops are likely to have been placed, given their understanding on how small traders manage their risks and positions. So what happens? The large institutions start to trade against the direction of the forecast movement. They move the price in the opposite direction to a point where they trigger the stops put in place by the smaller investors and traders, the people like you and me. This in turn increases volume and volatility and serves to move the price further away from what was identified as the entry point. This can be seen by the downward movement of the black trend line compared to the direction shown by the blue 15-year trend line. The large institutions continue to trade to increase the adverse trend to a point where they can start to liquidate their positions and take profit. This is where we start to see a reversal of the bearish trend created. Unless the combined interest and volume of trades from the smaller investors and traders was sufficiently high to prevent the adverse trend, the signals that would have been identified and confirmed by analysis will have been proven to be false. The big guys get the money and the small ones take a loss. This is an activity we refer to as volumetric arbitrage. Okay, so it doesn't sound good. You do everything right. You place your stops, minimise your risk, and yet you end up losing money. Now, don't be downhearted. There is opportunity in the face of adversity. If all the signs and analysis confirm this was a good potential trade, what's changed? Okay, so the big institutions have moved in and reversed what was expected. Having sold the spread, they're now going to need to close their positions at some time or risk a reversal that will cost them money. Anticipating when this is going to happen can present an opportunity. Buying the spread as the big guys start to close their positions will result in you being able to ride the bullish trend that follows. If you were long at the original point and your stop was triggered, this presents a chance to recoup losses and still make a profit. If, however, due to the increase in activity, you decided not to trade at the entry point, suspecting volumetric arbitrage was starting, but you traded at the end of the institutional activity, you can reap even greater rewards. Further evidence can be seen on this slide showing the interest and volumes for the spread on sugar that relates to the previous slide. You can see a steady increase in interest and volumes leading up to a peak on the 12th of June when the downward trend started. This was the entry date identified by the database. This is the perfect time for the big operators to jump in at the expense of small investors like you and me. Why push the prices to the other direction to the point where almost all private traders will be forced to close the trade at a loss? As I said earlier, this increases volume and helps drive the price lower to where most likely the big operators will begin to collect their profits and close their positions. Then, when such manipulation ends, the market returns to realign with what was originally identified and confirmed. Often, this adjustment happens quickly. In this type of situation, it's better not to intervene when everyone is focusing on the same thing. Wait for the institutional sharks to finish their activity. Those unfortunate small traders caught in the reverse trend will have lost interest and the opportunities to benefit from the correction that follows. The lesson to be learnt from the examples shown is despite all the analysis and getting the correct signals, when the sharks move in, it's better to swim with them rather than try and beat them. Small traders and investors, regardless of how numerous they are, would never have the volumes and interest to take on and beat the institutional traders. But it can pay to befriend them and follow their activity and exploit the movement to our advantage. Looking ahead to what else there is to cover on this theoretical course, we will be moving on to a new topic in the next episode, namely money management. It is so important to manage risk when trading, and in the next video we'll talk about position sizing and what capital to use when trading. I look forward to speaking to you soon. Bye for now.